Well, let's continue tracking the market and welcome in our next guest. Sunil Koul, Global Emerging Market Equity Strategist at Goldman Sachs, is with us. Sunil, what a pleasure to welcome you back on the show. Great to have you on. And the market is now wondering which way to go because we're almost getting back to all-time highs. It's trying to take out the recent trading range as well. But then I guess, some nervousness creeping back in. Let's sort of understand your construct. How do you feel now that the earnings season is wrapped up? A little better than most estimates. But what's the overall thesis?
Yeah, Surabhi, first, thanks for having me on. I think you're right. The earnings season was much better than expected, even better than what we as well as consensus were thinking. But I think in terms of the markets where we are, there are a couple of things which are important in here. One, I would say, I think the rally we have seen in the markets is obviously a sort of global rally, which happened because people got a bit more comfortable on the tariff side. And Nifty has rallied 12% from the lows. But I think what's important to keep in mind that if you look at the broader emerging markets, that rallied sort of almost 20% from the lows. So it's kind of a more global rally. And that's partly because market is starting to kind of take out any sort of left tail risk from the global growth slowdown because of the tariffs, right? I think specifically for India, what matters more in our view is that what happens on the domestic growth cycle, right? So if you remember, we had been sort of in this growth slowdown, earnings downgrade cycle for the last 8-9 months. And that was the prime reason why we had downgraded the market back in October last year. And I think there, mark to market, we are starting to turn a bit more sort of constructive fundamentally, because our core view is that given how the season has been panning out, it does look like the earnings season is kind of bottoming out here, and we're kind of seeing signs of recovery in corporate earnings. If history is any guide, we have been in this downgrade cycle for 8-9 months now. I think the typical downgrade cycle tends to be like 10 months long, going back to last 2 decades. But I think more importantly, I think the estimates are become more reasonable now, right? Coming into the year, we had consensus looking at around 16% earnings growth in India. We were more like 12-13%. We obviously cut our numbers a little bit after tariff announcements. But right now, if you look at the consensus numbers, they've gone from 16 to 11, which is more or less in line with where we are. So our sense is, look, I think the numbers have kind of caught down or to our estimates. Cycle has been sort of long enough over the last 8-9 months. And I think there are enough signs given sort of the RBI's sort of easing, given the fact that as you head into the sort of festive season, hopefully we get a decent monsoon, you could see a recovery in consumption. And so we are kind of hopeful that the earnings cycle is kind of turning around here. I think the issue obviously remains that the valuations have kind of re-rated back to 23 times, which is expensive. And so we don't have as much upside at the index level for Nifty. So we have a 26,200 for Nifty, which is, I guess, 4-5% upside from current levels. And if you bake in currency appreciation of 2-3%, that's roughly around 6-7% upside in dollar terms, which is not bad given where the markets are. But we think it's kind of more a stock pickers market, more sort of alpha beneath the headline index. And that's where we are advising people to pick up stocks and sectors.
All right. Hi, Sunil. Good afternoon and good to see you. With Nigel on this side. Sunil, good to hear that you're sounding a little bit more optimistic with regard to earnings going ahead. And that's why you're factoring in 12% odd. And the Nifty target, as you said, 26,200. But the macro backdrop is looking much better for India. The crude oil prices are well behaved. The rupee is fairly stable. And also the policy coming out of the RBI is looking solid. And the optimism is there on the consumption picking up here in India. So in that sort of a backdrop, could you comment first on the macros? And also with this backdrop, I believe you'll have upgraded financials as well as consumption. What do you like from the consumption themes?
Look, I think the macro is obviously better, Nigel, as you mentioned. I think that's kind of better for everyone. Most of the emerging markets are kind of net importers of sort of oil, barring a few pockets, kind of are inherently short dollars. And so I think the global environment where you have lower oil prices, weaker dollar actually tends to benefit a lot of the markets. India is not the only market, to be fair, which benefits from that. But I think if you compound on top of that, the domestic situation, wherein, as I said, we do think growth is kind of picking up a little bit here. We do think, obviously, fiscal drag is less than it has been in previous years. So that is not a positive, but at least the second derivative is kind of turning favorable there, as meaning that the government doesn't need to consolidate as much as it has done in the prior years. Monetary policy obviously has turned much more favorable. especially in terms of the liquidity. And then there is the expectation of consumption recovery, as you put it. So if you combine both the external environment becoming a little bit better, but equally kind of domestic environment also turning a bit more favorable, that's the reason to be a bit constructive, which is what I said at the beginning, that the reason of not having a stronger upside is just the valuations, not the cycle. I think, as I made pretty clear, I think we are pretty constructive on the cycle recovering in here. To your other question, yeah, we did upgrade financials a couple of weeks back, and we are sort of advising people to be sort of positioned within financials and consumption. I think consumption, we have the variety of sectors where we are overweight on. So we are overweight on autos, we are overweight on both discretionary bit as well as staples, as well as kind of we like to play consumption through the broader theme of tourism, which obviously includes kind of hotels, restaurants, airlines, bits of that. And so it's a broader range of consumption sectors where we are overweight on. On financials, I would say, look, I think the key view there is that you probably have a better earnings visibility now because the RBI obviously front-loaded rate cuts, which may be sort of impacting NIMs in the near term. But I think as we sort of some of that NIM pressure could be offset by the easier liquidity conditions and the CRR cuts from September onwards. So we think some of that pressure could be offset. But equally speaking, I think you could see better sort of credit offtake with the better liquidity conditions. And net, we think financials should still do okay because it's one sector where valuations are still kind of more mid-cycle as opposed to expensive. And if your earnings visibility and ROAs are improving, that should be better for financials. The one thing I would say, I think you still need to be a bit more stock specific within financials. And so we do like pockets of banks and BFCs, small size banks. I think with banks, you probably are looking at banks where you have high loan to deposit ratios. Our analysts have been flagging that within NBFC, we like a few pockets, especially guys who have sort of a higher proportion of fixed assets, for example. And I think those are the pockets you need to sort of look at. So be a bit more selective, but broadly speaking, we think financials and consumption should be sort of driving the markets higher in this leg of the rally.
Sunil, hi, afternoon. This is Reema here. So, so far the DIIs were cushioning the Indian equity market. So despite FIs selling or muted earnings growth, India continued to do well. But now the latest equity inflow numbers show for the month of May, there is a sharp moderation. Is that a bit of a risk, especially when you see it in light of the expected supply that's coming into the market?
I mean, yeah, part of it could be that. I mean, we are obviously sort of busy on our desks in terms of block deals and activity. And so there is a bit of supply that's hitting the market, to your point. But I would say, I think we also have to keep in mind what the global environment is looking like, in the sense, I think there is a increasingly more and more focus from clients we speak to in terms of diversifying away from sort of US to non-US equities and EM. And I think we're kind of seeing inflows into many pockets of EM. I think from the April 9 lows, from the data we are tracking, there is close to sort of 20 billion of inflows that have come into the emerging markets. 6 or 7 billion of that has come into India. So India has obviously got its share. But I think this broader kind of need for diversification and sort of reallocation of flows out from US to non-US pockets is something that could be a tailwind from a FII flows perspective for India as well. And as we all know, I mean, large part of the rally and the fact that market was held up, as you said, is because of the domestic flows and SIP flows, and foreign positioning in India is still pretty light. And so, I mean, just looking at the year-to-date flows, you're kind of at one point back in April, you were down 18 billion year-to-date. Now with the inflows, you're kind of still down 11 billion year-to-date, right? So net, we haven't seen any inflows in the market, right? So I would say the foreign positioning is still clean. At the margin, you still, I mean, from what we track, the domestic investors are still running a little bit higher cash levels than they historically have, close to kind of 6% versus 4% historically. So we still think that domestic investors also have, or mutual funds still have some firepower left to support the market. So the combination of sort of domestic liquidity plus kind of broader money coming back into the emerging markets could mean that I think the liquidity environment could remain supportive and should be able to absorb any supply we are seeing in the markets.
Sunil, I mean, to go back to that point you made, you said the leaders of the market in this phase will be consumption and financials. So that would be a departure from where we were till September last year, right? It was all industrials, capital goods, railway, PSU, defense, all of that. So do you see those sectors falling off the wayside? Because we keep seeing these off and on trading rallies. I mean, railway stocks, for instance, last week were quite excited. What should people be doing? What's your advice on the old leaders, on the yesteryear's leaders on the industrial side?
It will be a rotation in the market, Surabhi, as said. I mean, the last 18, 24 months was obviously unusual in the sense that, as you said, financials were not the leaders of the market, and it was kind of more industrial-led rally. Although I think if you go back in time, a large part of the bull markets in India or sort of stronger performance in India were actually led by financials. So in that sense, it's not sort of a large departure from where the history is. But obviously, there were reasons for financials not doing well, and large part of that was because of the regulatory sort of macroprudential tightness. And I think the clear evidence that RBI doing a U-turn on that policy is what is the catalyst, I think, for financials. And so I think we are fairly comfortable with the fact that financials could be the leaders, and with all the sort of catalysts that are lining up for the consumption, that seems to be the case. The reason we are not as bullish on the broader infrastructure side of things is obviously because private capex, as we all know, hasn't come back, and it does feel like at the margin there is limits to how much the government can continue to spend on infrastructure, given other needs as well. And so we are looking for rotation out from some of those pockets. The one thing I would highlight, though, I think we have in our allocations, we are underweight cement, we are underweight industrials. So we do have that strong preference of financial consumer versus the rest of the market. But we are sort of neutral on defense. So if there is one theme within that broader manufacturing industrials complex where we still feel that there is more to go, given how the geopolitics and the world is moving, that would be defense. So we wouldn't be sort of cautious on the defense names. I think there is more room for that to come through if that gets backed up by the government orders and all of that. But we will be probably more cautious on very highly capex sensitive sectors, which are more to do with sort of construction cycle, so to speak.
Okay, all right. That's pretty comprehensive. Sunil, thanks very much. Explains your point of view very well, and the rotation and leadership change that you are expecting in the market as well. Great conversation. Thank you so much. And we'll look forward to the next one. You have a great rest of the afternoon. Well, that's a view from Goldman Sachs coming in. We do have to take a quick break on that note. Come back on the other side. And of course, as usual, we'll get